Welcome to The Wealth Architect, the place where finance becomes simple. Today we're diving deep into a topic that's not just going to change your life, it's going to revolutionize it. We're talking about the economic cycle. Now, you might be thinking, how can understanding the economic cycle affect me? Well, imagine making investment decisions with confidence, knowing you're backed by the knowledge of how each person's actions impact the economy. Imagine being ahead of the curve, predicting market trends and securing your financial future. That's the power of understanding the economic cycle. So, buckle up as we break down the economic cycle in a nutshell. The economic cycle refers to periods in the economy where there is growth and periods where the output falls. Before we start, smash the like button and subscribe to never miss out on any of our videos. So now, sit back, relax and enjoy the video. So, what exactly is the economic cycle? Well, in a nutshell, it's a pattern that describes the ups and downs of an economy over time. An economic cycle, also known as a business cycle, refers to economic fluctuations between periods of expansion and contraction. Factors such as gross domestic product, also known as GDP, interest rates, total employment, and consumer spending can help to determine the current economic cycle stage. Understanding the economic period can help investors and businesses determine when to make investments and when to pull their money out, as each cycle impacts stocks and bonds as well as profits and corporate earnings. The economic cycle is also known as the business cycle, and it's the fluctuating state of a market-based economy. An economy is a term that describes a set of production and consumption activities that determine how resources ought to be allocated. In today's world, virtually every economy is a market-based economy in which the laws of supply and demand determine the prices. Supply and demand pressures influence the economy through different variables such as global economic conditions, trade balances, productivity, inflation rates, interest rates, and exchange rates. The variables, in aggregate, shape the economy and the state of the economic cycle. There are some economies right now that are experiencing growth over the long term, whose GDP has been trending upward for several years. On the other hand, some economies have been experiencing negative growth, and their GDP has been trending downward for many years. Regardless of which case you consider, there will be fluctuations in their positive or negative growth trend. That is to say, there are periods in which these economies will have experienced either upward or downward movements. Although an economy might have been growing, it has undergone some downward movements at some point and has picked up again. There are many reasons why an economy experiences fluctuations, regardless of whether it's an upward or a downward trend. Firstly, it could be due to what we know as seasonal fluctuations. These fluctuations are highly correlated with the season that the economy is in. For instance, during winter, the economy of a coastal country dependent on tourism might experience a fall in output, as there are not many tourists coming, and jobs and production have fallen as a result of that. These seasonal fluctuations are temporary and usually last a very short time. So the economic cycle goes through 4 stages: expansion, peak, contraction, and trough. The first phase is expansion, also known as the growth phase. During expansion, the economy experiences relatively rapid growth, interest rates tend to be low, and production increases. The economic indicators associated with growth, such as employment and wages, corporate profits and output, aggregate demand, and the supply of goods and services, tend to show sustained uptrends through the expansionary stage. The flow of money through the economy remains healthy and the cost of money is cheap. However, the increase in the money supply may spur inflation during the economic growth phase. However, as the economy reaches its peak, we enter the second phase, the peak phase. The peak of a cycle is when growth hits its maximum rate. Prices and economic indicators may stabilize for a short period before reversing to the downside. Peak growth typically creates some imbalances in the economy that need to be corrected. As a result, businesses may start to re-evaluate their budgets and spending when they believe that the economic cycle has reached its peak. Once we hit the peak, we enter the third phase, contraction or recession. A correction occurs when growth slows, employment falls, and prices stagnate. As demand decreases, businesses may not immediately adjust production levels, leading to oversaturated markets with surplus supply and a downward movement in prices. If the contraction continues, the recessionary environment may spiral into a depression. However, the economic cycle doesn't stop there. The final phase is the trough, also known as the bottom of the cycle. The trough of the cycle is reached when the economy hits a low point, with supply and demand hitting bottom before recovery. The low point in the cycle represents a painful moment for the economy, with a widespread negative impact from stagnating spending and income. The low point provides an opportunity for individuals and businesses to reconfigure their finances in anticipation of a recovery. So, why is it crucial to understand the economic cycle? Well, every person is a participant in the market-based economy. The defining factor of the success of a market-based economy is that it essentially makes everyone better off by producing and consuming more goods and services over time. The GDP of an economy captures the increased production and consumption levels, and a growing GDP is an important aspect of a successful economy. Given that everyone is a participant in the overall economy, it makes sense that everyone is impacted by the state of the economic cycle. It's usually in everyone's best interest for the economy to be in an expansion phase to accumulate more wealth. Now, you guys must be wondering how these economic phases will impact our lives? Well, when the economy is in expansion, businesses generate profits, which leads to hiring more employees and more disposable income and spending. It, in turn, leads to more profits for businesses, and it continues in a virtuous cycle. When the economy is in contraction, businesses lose profits, which leads to downsizing and laying off employees. When employees lose their jobs, there are less disposable income and less consumer spending, which leads to even lower business profits. An economy should be in continuous expansion. However, contractions are needed to keep inflation in check and to make sure the economy does not overheat. An overheated economy is an economy that has experienced a long period of strong economic growth, but also has begun to reach high levels of inflation. And that's the economic cycle in a nutshell. By understanding these phases, we can better navigate the ups and downs and make an informed decision and choice. If you find this video more insightful, don't forget to like and share your thoughts in the comment section. Subscribe for more videos like this. Thank you so much for watching.